So in this video, I wanted to look at Canopy Growth, Aphria, and Organigram and kind of compare the three companies because I feel like a lot of people they miss the point when it comes to comparing companies and they're not doing it quite right. So whenever you're looking into the stock market and you're looking at the companies, you're not looking for the biggest company. You're not looking for necessarily the best company to invest in. You're looking for the company that's going to generate the most profit for you over the period that you want to invest into them. And a lot of the time, people invest in the biggest company. Like people will just look at Canopy Growth, they'll look at it, it will look amazing to them, and they'll invest into it. But what you should be doing is you should be going on Canopy Growth. You should be looking at their market cap. 1.83 billion. That's a lot. You should be looking at what they're currently making. You should be looking at what they could potentially be making in the future. You should be looking at everything else. Their reputation, their name brand, the people that are working for them, and you should be comparing all of those things to other companies and seeing how they fare against them. And then once you do that, you'll have a better idea of if your company is as valuable as you might think it is. So I'm going to be trying to give you an insight on how to do it. I'm not actually going to do all of it because to be honest, currently in the marijuana industry, it's pretty much impossible to actually do that because information isn't very readily available. Also, a lot of companies are growing. A lot of companies have unique scenarios to each other that are difficult to compare. And a lot of companies, just in general, when you have a company that's growing and not all of their financials might be as clear as you want them to be, it's difficult to look at the financials and figure out the cost per gram and how they're going to look in the future and all of that stuff, and then compare it to another company which has slightly different ways of doing things and all of that. But we're going to try and do that. So before I go into the numbers, we have all three financial quarters. I have the latest financial quarters from each one of these companies. Obviously, these financial quarters are not very reflective of where the companies are at this current moment because things have changed since then, but it is the most up-to-date information that we currently have, so that's what I'm going to be using. Now, I could put this into a spreadsheet and make a nice and pretty graph, but since these quarters don't really reflect the companies very well because the companies are at different stages at this point, plus there's different stuff, kind of like the recalls that I'm going to be talking about in a little bit, and a lot of different other things, I don't feel like putting these into a spreadsheet or some sort of a graphing utility would be a very good way of looking into them, because whenever you put something into a spreadsheet or some sort of a graph, then people tend to look at it and visually make up their mind about a company, when in reality it's more complicated than that. You need to look at things that are more difficult to judge than just pure numbers. So we're going to start with Organigram. So this company is the smallest one of them all. It currently has well, there's no market cap in here, but the market cap is about 200 billion, 200 million. 200 billion would be insane. But 200 million market cap, and in the past 3 months, they are the only company that's really lost a lot of value instead of gained value. And the reason for that is because they had a recall recently. They had pesticides in their marijuana, and the pesticides weren't life-threatening, but they were recalled. And the recall was pretty big, and this company is going to lose millions off of that. So that's a pretty big deal. And because of that, people are afraid to invest into them because they're the first big company that kind of made a big recall. They're going to lose a lot of money on it, and they're going to be known as that big company that made the recall for quite a while, and their reputation is going to suffer because of it. So you got to take that into account. Canopy Growth recently merged with Metrum, and Metrum did have a recall as well. The difference between Metrum's recall, Metrum had pesticides in their stuff as well, but Metrum's recall was smaller, but there is evidence that says that Metrum knew what was happening and just wasn't doing anything about it, or wasn't being as transparent as they should have been. While in Organigram's case, there is evidence, well, there is no evidence of that, so it is likely that it was just contaminated soil of some sorts. So that's the difference between the two companies. However, since Metrum merged with Canopy Growth, it is more likely that the whole recall is not really going to affect Canopy too much. I mean, their stock did drop this is the gap. So 7% and then kind of rebounded a little bit. So let's round it off to 5%. Their stock dropped 5%, but it's likely that in a week or two, since the company is so big and since so many news come out from them, it's likely that this will be forgotten and none of it will be mentioned in the future again. So that's that. By the way, sorry about the little stuttering. It's pretty cold where I am, and it's cold. I'm shivering slightly. I need to go put on a jacket or something. Anyways, so when looking at these companies, you want to first of all you want to take that into account because reputation matters. It actually matters quite a bit. Also, Canopy Growth and Aphria are on the Toronto Exchange, so they have a lot more exposure in terms of to institutional investment. Organigram is not on there, so they don't have that exposure. So take that into account as well. So looking at their quarters, so one of the things that you might want to do, one of the things that I'd like to do just to kind of give myself an idea of where the companies are at. So we're gonna look at the sales revenue, just the revenue. We're not gonna look at the profit. Well, you can look at the profit, but these companies have a lot of expenses that over time will kind of fade away, or they won't be as much. So it's difficult to say exactly. So it's difficult to get a good idea based on the profits of where these companies are at. But I like to look at the sales. So this is Organigram. So 2.2 million in sales, and I like to compare it with sales and marketing, for example, and general and administrative expenses. So this is pretty interesting to me because it kind of shows where the company is going. So for example, Organigram, relative to their sales and revenue and relative to their assets, which are currently are at in this quarter they're 57 million. So relative to that, they spend 667,000 advertising, which is about it's about 30%, right? No, that's way less than that. 1 second, I need to. It's about 25-30% of their total sales. If we look at Canopy Growth, for example, and this is before the Metrum merge, so Metrum is not included in here, which is why these data sheets aren't very good, but they do give you a general sense of how the company is doing. But if we look at Canopy Growth, their revenue is 9.7 million, and they spend 3.7 million on marketing, which is a pretty big, which is a larger portion of their sales than Organigram. Their name always confuses me. If you look at Aphria or Aphria, they had a revenue of 5.2 million, and they spent 1.8 million on marketing. So also about 25%, give or take. Actually, this is about 30%, 30-35. So that's pretty interesting. If you look at general expenses relative to everything else, so general expenses, Aphria had 1.2 million relative to their 5.2 million sales. Canopy Growth, however, they had 4 million. So that's more than 40% of their total sales revenue, which is a lot. So Canopy Growth is spending a lot of money on general and administrative expenses, and that's not something that particularly it's not something that particularly causes a red flag, but it is something that you should know. You know, if you want a company that, for example, has lower expenses and that has more potential to make profit in the short term, then you might not want to buy Canopy Growth because their expenses are pretty high. At least their general and administrative expenses are pretty high. So just something to consider. You know, you want to go through and you want to do this with several different measurements and look at the different companies and figure it out. If we look at Organigram, their general and administrative expenses were only 540,000 compared to their 2.2 million sales revenue. So you have 25% of your sales revenue going on general and administrative expenses versus 40% from Canopy Growth. So you want to be doing stuff like this and looking at it. You can also compare, you know, their expenses relative to their assets, their growth potential. Like Organigram, currently they plan to do 227,000 foot of production space. Canopy Growth has a lot more than that. They plan on doing, so they already have 168,000, I believe, of licensed production space, but they will do more, obviously. They have land of over 500,000 square foot. Aphria is currently doing this. They have their expansion stages, which you can look at. And also the interesting thing about Aphria is that they have a lower price per gram production than everybody else, or mostly than everybody else. This is a little bit tricky to differentiate between because a lot of companies like Canopy Growth, they're not currently They're not producing it very cheaply, but it's not exactly clear how cheaply they can produce it if they put the resources to try to make it as cheap as possible. So that's a difficult thing to say, but it's definitely a good sign if your company can produce marijuana at significantly cheaper rates than their competitors. That's a very good sign. So if you want to invest in the very long term, then you might want to be looking for this. This should matter to you quite a lot if you're going to invest in the long term. If you're investing in a short term, then Canopy Growth's production, which is higher than a lot of other companies, is not that much of a big deal because currently demand is high, and if you're producing at a slightly higher rate than everybody else, even if it's double, then you're still going to make a lot of money and it won't matter that much. But in the very long run, it definitely matters. So yeah, those are some of the things that you kind of want to look at. Also, if the company that you want to invest into is using a lot of their is financing themselves by issuing new shares, then that might cause a little bit of a red flag. For example, OWC Pharmaceuticals, they have no income and their stock is jumping up like crazy. And one of the ways that they're going to finance their growth is by issuing new shares. Now, they are going to try to issue as least shares as possible, but still, they're going to be issuing new shares. And a lot of companies are doing this, but a lot of companies are close to making money. This company is a little bit tricky because we're not sure exactly how close they are to making money. So, you know, if you have company A and they issue 5% worth of stock every single quarter relative to what they have, so 5%, and company B issues 10%, and all else remains the same for both companies, then you probably want to invest in company A because your stock is going to gain more value over time. Now that's an extremely simplified scenario, and that's not going to be happening a lot because every company will have something different. Like, for example, how do you price in Organigram's recall and the ruined reputation of it? It's pretty difficult to say. We don't quite have the amount that they lost yet. It's going to come out in about a month, and then we're going to find out exactly how much money they lost on the recall. But yeah, so these are the things that you want to be looking at when you're looking into these companies. You want to be comparing them to each other, and you want to be finding out how they relate to each other, and then you get a better understanding of what's going to be happening. You can look at Reddit and see what people are doing, but be careful of Reddit. People can be biased, and you generally, when investing in stocks, you want to take everything with a grain of salt. Don't believe everything that you see 100%, even if it's coming directly from the company. Some companies have a very positive outlook on how they're going to do in the future, and you know, consider what would happen if that outlook wasn't met, or if there was a roadblock. Like, what would happen if legalization got delayed? Which companies would suffer the most? Which companies would suffer the least? Well, the companies that are currently in the medical sector, they would probably suffer the least, while the companies that are positioned better to profit off the recreational legalization, they would suffer more. So something to consider. Hopefully this helped. If you have any more questions, ask them in the comments and I'll do my best to answer them. But hopefully this gives you guys a general sense of what you're supposed to be doing if you're going to be researching these types of stocks. And yeah, this is kind of how you get an idea. In this market, it's pretty difficult at doing it because everybody's still expanding and it's a new market. But in the future, this will be easier to do, and you should be able to get a better idea of how your company compares to everybody else.